You guys have any plans this weekend? What's going on?
This is actually a weekend of rest. I've had weekend after weekend of just something, right? I'm sure everybody can relate to that at one point at least. And then next weekend we got a lot. So this weekend is kind of just I'm gonna hide somewhere and hopefully no one gives me something to do.
I believe that's called summer, Austin.
Yeah. Well, luckily that's over. Monica, how about you?
I always like the resting weekends with two kids. There's not a lot of that, but I think it's probably going to be one of those too.
Good.
I'm good.
Yeah, I will not be resting. Hannah's got the weekend off. She's going to visit some friends down in Connecticut for the weekend. So I've got the two kids. Should be fun.
Dad and the girls.
Yeah, if you're losing your mind, just text us. We'll
yes. Can you fly up from Florida as soon as possible, please? Yeah.
So that's cute. You got any things you're doing with them?
We're gonna go visit my grandmother in New Haven. So
okay.
I figure if I can,
someone else.
Well, it's 2 hours each way, so I figure that's 4 hours of driving that I wouldn't otherwise have to be chasing them around, in the house. So just take up some of the time.
There you go.
No, my mom and I are going to go down there, and it's her mother, so we'll see her, and should be nice. Should be fun.
Cool.
Yeah. Yep. Should we get going? Should we get this thing started?
Yeah, let's do it.
Let's do it.
Awesome. Well, I will take a moment to welcome everyone to our first episode of Amplified Wealth. Whether you're watching on YouTube or tuning in via audio on Spotify or Apple Podcasts, we want to thank you all for taking the time to listen. Our goal for the show in general is going to be to discuss timely investment topics, wealth perspectives, etc., but in an approachable and, dare I say, unplugged manner. No, the irony there, right? Because we're plugged in. But we're going to have different guests from the firm internally and some external guests down the road as well. So hopefully we can just chat about what's going on in a more laid back and bantering format. Today's guest is our colleague, Monica Jalife. Thanks for joining us, Monica. And we're going to be talking a lot about interest rates, the state of the bond market, and how that pertains to future interest rate policy with the Fed. We just had a Fed meeting a couple days ago, right? And it's causing some stress in markets. So very excited to dive in and get started.
Maybe it's a good idea Nick didn't give me the applause button yet, because I would have hit that like 5 times during that whole introduction.
There you go.
I felt a lot of horns and applause was needed there. So let me read your background, Monica. So Monica Jalife is a wealth advisor at the firm. She also heads the firm's Global Asset Investment Committee. Monica has nearly 15 years of finance experience and holds the Chartered Financial Analyst, CFA.
It's more like 25, but
25. All right.
Excellent.
So 10 years ago. So has 25 years of finance experience and holds the Chartered Financial Analyst or CFA and Certified Financial Planner CFP designations. She earned her MBA in Finance and Global Business from NY Stern School of Business and her undergraduate degree in Industrial Engineering, out of all things, from, and bear with me here, the Universidad Iberoamericana.
Why don't I say it?
How did I do there?
Hold it there, Austin. Let's hear it, Monica.
Universidad Iberoamericana.
Oh, it sounds a lot better when you say it. Okay, thank you. Yeah, I could tell you I did Google it, and I was listening to the Google machine talk to me, and I guess I still messed it up. So anyway, Monica currently resides in Orlando, Florida, with her husband, Francisco, and her 2 young daughters, Camelia and Sophia. Monica enjoys spending time with her family, reading, skiing, and tennis. She is also very passionate about travel and learning about different cultures. She has visited 5 continents: Australia, Africa, Europe, Asia, and South America. Welcome, Monica. So I know we have a lot
Thank
of
you.
good topics to talk about here. One, when I read your bio, the first thing that comes to mind is, how does somebody go from an industrial engineer studying in Mexico to a financial advisor in New York City?
Well, it's an interesting story. The truth is, I moved to New York. The first time I came to New York, I really fell in love with New York, and I knew at that point that I wanted to try my luck.
Was it the rats? The rats,
It was not the rats. It was the
the garbage in the
buildings.
street. Yeah.
It was the buildings at night. It was just such a dynamic and lively city. So I know I wanted to come here. It didn't, it did help that I had a boyfriend that was also living in New York City, and I decided to try my luck. But as I painfully discovered, there's not a lot of engineering jobs in the city. And, this was also 20 some years ago. So there was not a lot of the job tools or job search tools that we have now. So it was really like every Sunday I would think about the Sunday. And instead of thinking about all the fun things I was going to do, is thinking about, getting the New York Times and looking at these little boxes of job, openings, and basically going through all of them. And interviewing, and I interviewed a lot, and I think it's a little bit of my passion for working with people, and just a little bit personality, a little bit of luck, but I ended up at the firm, and it's been a great, it's been a very steep learning curve since. I've learned so much practical while working, and I started from zero. I started from doing all the different, roles within the firm. So it's been great. It's been a lot of learning. It's been challenging at times, of course, but it's been a good ride.
And how was
Life
the
before LinkedIn,
decision made ultimately to head back down to Florida?
Life before LinkedIn was a little bit more complicated than it is now, because even the networking and yeah, it is. Now things are a little bit easier, but it's I made it, and I learned a lot. And after I joined the firm, I also did went and got my MBA, and I did the CFA and CFP. So seems like I've been taking exams and in school for a long time. After I completed the CFP, I said I'm not taking any more exams, and now I'm starting to think about other designations, so maybe I, never say never. But that's how I ended up. Florida, I have to say that growing up in Mexico City, we have great weather, and it's maybe a little hot sometimes, but it's never too cold as it was in New York. And before, when I got married and moved out of New York City into the suburbs in Connecticut, the winters really started to be harder for me. And I don't know if
Definitely.
you recall, but we had a couple of really bad winters back in, I don't know, maybe when it was Sandy, and we had a really couple of bad winters where we were getting snowstorms in October already. And I just thought, I can't do it. I can't do it anymore. And I was, because I already had a pretty good time under my belt with the firm, and people knew my work ethic. I was able to kind of have that conversation and say, look, I really am not so happy, and this is an extra added level of stress, and I'm going to do it, but I'll make sure that I'm here as needed. And increased travel came with the package. Right. But I haven't looked back since.
Yeah.
You were blazing the remote work trail before COVID and before it became popular, right?
Yeah, and I'm actually absolutely happy that I had moved to Florida before COVID, because I cannot, imagine how it would have been if I was in Connecticut then. But, right. But it's also been a great ride, and I enjoy being in Florida. My kids probably won't really remember Connecticut or New York City, so we're good.
You can travel there with them and show them.
Absolutely,
a great experience for them. So.
And my husband's family's up there, so we get to go all the time. Plus, I get to go to work. So.
Yep. Great. Best of both worlds.
Yeah.
Awesome. Should we dive in? I know we're here today to talk a little bit about, the state of the bond market, as I mentioned. You were kind enough to put together some charts for us, which we'll walk through and dive into. But let's talk a little bit maybe about the most recent Fed meeting that we just had. It's causing a little bit of stress in the markets. Did you listen in, Monica, to what was said to Powell's press conference?
Yeah, and I think, I'm not too surprised, and I don't know. I think there's a little bit of surprise in the market, and really is the fact that people were expecting or anticipating, the Fed to really start reducing the level of rates next year, and they just got a little bit of dose of, oh no, this is not happening yet. And I think that's why we had a weekday yesterday, and people are kind of just adjusting to the reality that we're really in this higher for longer environment. And even when you look at the dot plots, I mean, the level where they were saying 2024 is going to be where rates end up is really not that meaningfully different from where we are right now. So people are really saying, well, we want rates to go lower. This is going to have an impact in equity markets at some point. And I think that's not exactly the message that was delivered. And
right.
That's why I think there's a little bit of adjusting of expectations again.
Yeah, I think we have a picture of the dot plot here in our slide deck. So let's turn to that.
Yeah, let me turn.
What is the
here.
dot plot? Let me start there for viewers who don't know what the dot plot is. This was September 2021, right? Monica, do you want to take a stab at explaining what the dot plot represents?
And before you jump into that, Monica, just so everyone's clear, this is Friday, September 22nd. So we're recording today. I'm not sure when this is going to air, but we're talking about recent changes. So just so everyone has a date in mind, there you go. Sorry for interrupting you, but
No problem. Thank you. This is. Well, what's interesting, and I'll start with what the dot plot is. But the dot plot is really from all the different members of the committee, of the interest rate setting committee, what their views are and where rates are going to be at a certain point in time, right? But what's interesting, and I think that's something that the Fed has been criticized for, is that even when you think about where they were putting this dot plot at the end of 2021, they were really just anticipating 1 or 2 rate hikes, and then come like January, inflation readings kept being kind of really high. They really kind of pivoted, right, and they switched what their expectations were, and they started really rating high, increasing the rates much more at a much faster and stronger or more magnitude of rates over the last year. And we had a lot of rate hikes. We basically went from 0 to 4 or early 5s or low 5s at the end of the year. So yeah. They really changed their tune. But that's what that Fed plot, the dot plot shows us, is where are we going to be in terms of rates in the long run, and where are we going to be by the end of 2023 or by the end of 2024? Now, something interesting to see, and you can see it here in the graph, is that at the end of when this dot plot was
Monica,
screenshot.
This is the September 2021 dot plot. Now, just to be clear for everybody, right? Each dot represents a member. Right.
That's where I was going, because
right, okay.
Here's the interesting thing about that, is that if you see on 2021, you can see a very consistent line.
All the way on the left there,
dots.
Right? All the way on the left there,
right
around just above 0, right?
Yeah, it's all there. I mean, there's consensus, right, of where we are. But then you start to see 2022 a little bit. Now you have some dots, at lower levels of rates. Then you have some that are, thinking they should be higher. But then when you start to look at where they are right now, and you start to see there is this big wide range of where different members are expecting rates to be.
Yeah.
So I think that's just an interesting point to mention.
If we can just jump back for 1 minute to the September 21, so 2 years ago, where the Fed thought they would be, they didn't even, half the people did not even think there would be a single rate hike in 2022. And the highest projection at the end of what will be next year was, 2.6% interest rates? We're at 5.5% today. So we can fast forward again to today, but it's just amazing that no one projected in the Fed, no one projected this sort of pace or magnitude of the rate hikes that were needed or would be needed to really combat inflation.
Right. Which really says something, right? You know, the Fed has some of the smartest people in economics and finance, right? Staff.
We hope so.
Right. We hope so. Both not only leading the Fed members themselves, but the people working for those people, right? And they can't even project, accurately what's going to happen next.
Yeah. Fascinating. So where are we today? Today, we're, 5.25% to 5.5% on the baseline rate?
Right, all the way on the left here. Yep.
Yeah, and it looks like a little more than half are still projecting for one interest rate hike through the end of the year. So that was, I would say, expected. There is some dissent, which I think is interesting, right? There's disagreement within the different members of the Fed whether there needs to be an additional hike, which I also think is interesting before the end of this year. But then going into 24, there's a wide range of what the Fed FOMC members are thinking. Some people are thinking up to 1% in cuts, and someone's up there with another couple of rate hikes above 6%. That's pretty incredible to me.
Right, the lone wolf out there.
Not sure who that was. We should figure that out. Who was that Fed member? Maybe they're going to be voted out pretty soon.
or maybe he's right. The thing is, right.
It's a good point.
Because I know we have talked about this internally ourselves, but the economy has been very resilient, and the consumer has been extremely resilient. And yes, there's the excess savings from COVID that they're kind of working down, but the economy can continue to be strong, because if you think about it, there's this recession, right? The most anticipated and talked about recession that has not come, and the jury's still out whether we will get that recession or will it be that soft landing that people are anticipating. Higher rates. We've seen some cracks in the system. The economy will definitely slow, but we'll have to see whether this economy continues to be strong. Labor markets have been pretty strong too, and that's obviously contributing to inflation. So we'll have to let the data play out and see how it's all going to really turn out, to see where rates need to be, because you might still need some restrictive rates or a restrictive economy to continue cooling down the labor market, or maybe we get that Goldilocks soft landing. We'll see.
I think one phenomena that we've seen is that the markets consistently have underestimated the rate hikes and also are projecting rate cuts sooner than the Fed is telling us. And all along the way, what the Fed has been saying, they've done, and the markets have adjusted. So I tend to agree we'll probably have to take the Fed's word for it, and maybe the market's pricing in 1% of cuts. It seems like the Fed's kind of split right now, maybe 0.5% or so of cuts before the end of next year. So will higher for longer start to make a dent in the economy? That's surely what we're going to find out.
Yeah, and we saw in March, we saw the banking or the mini banking crisis, and maybe we haven't seen the end of it. Maybe there's still some consolidation in banks or smaller banks in the next quarters. We'll see. But I think we've talked about it, and we've talked about it in our commentary, and we've talked about it when you do the economic outlook updates. going from inflation from 9% to 5% or 6%, that I don't want to call it that it was easy, but it's easy to start to pull those levers, right, and have the impact. But what I call what's the last mile, which is to go from where we are currently to really go to that 2% that the Fed is targeting, that is going to be the hardest part, because all the levers that were easily pulled have been pulled, right? So, and I have a question where, are we really going to get to that 2% that the Fed wants to get to, or are we really in a higher interest rate, higher inflation regime in general, where maybe it's not, it's not going to be 4, but it maybe is mid twos, right? I mean, is 2% achievable, and is still realistic considering, all the other factors out there?
I mean, who even came up with 2%? Is that just some arbitrary number? Like, I get it's not 0 and it's not 10, but I thought it used to always be 3% was kind of the norm, and then the Fed kind of established this 2% baseline. I mean, I would be curious to know the history of where did 2% come from. I'm sure there's, as you mentioned, Austin, there's got to be some smart academic reason behind it. But what if they adjust their benchmark? What if 2.5 or 3 is actually the new benchmark that they start targeting?
Right. Because regime changes happen, right, within the economy, how the economy works. Could there be a case that there's been, a change in how our economy processes, money, with now the digital age, everything like that? Could that argue for a higher inflation rate? I have no idea. That's I leave that up to the smarter people at the Fed.
We're not going to get into crypto on this podcast, don't worry.
Well, we have a lot of podcasts to come, so we'll have opportunity to do that. But
Sure.
And if you think about it, also, just something real quick on this, is like over the last, I don't know, maybe 10 years, we were really in a disinflationary environment. And why is that? It's because globalization helped bring inflation down, reduce cost. Even things like the iPhone, right? Like the iPhone replaced your alarm clock, replaced your camera, replaced a lot of things. So technology and advance and innovation really was also had an impact on the inflation environment, and all of those things have kind of played their way. Granted, we do have AI, and we have to see how that is going to translate into productivity and into innovation, into bringing improvements to the economy. But a lot of those factors that were keeping inflation down might have already played out, and we'll have to see what the new factors are. But just a side note on that.
Yeah. So let's bring it back to the yield curve here. So let's flip to the next slide. Now, from our economic update webinars, last time we got a few people saying, "What is you keep showing this yield curve slide? What does it mean? I don't get it." So let me just quickly walk through this. Let's focus on the red line here. So at the bottom of the chart, you'll see 1M, 2M, 3M. That's 1 month, 2 month, 3 month, 4 month, 6 month, 1 year, 2 year, etc. going out. So that's if I were to buy a 2-month U.S. Treasury on that date, I would be able to get that yield just above 0%. If I were to go out on that red line and buy a 20-year U.S. Treasury, we go up, I could get 2% at that period of time.
And this was back in 2021.
Right. So these are all new issuance of U.S. Treasuries back in 2021. The what is this? The dark green line is June 2022. The lighter green line is September 2022, and the blue line is September 2023. So with that said, I will put the mic down and I'll let Monica.
Well, and what's something to bear in mind is that the yield curve is basically, like Austin said, it's a graphic representation of different maturities of treasuries across time, right? But in a normal environment, and I wouldn't really call the red one exactly normal, but in a normal environment where the economy is growing and functioning properly, what you have is that yield curve, and that graphic representation is upward sloping, meaning like you have something like this, you get higher yields as you go out in time, right? Shorter maturities, or you're going to get paid less. Longer maturities, you're going to get paid more because there's, you're
the time,
putting your
time
money
risk.
Exactly.
You're locking your money up for longer.
This is what we want every stock chart to look like all the time. Bottom left to top right.
Right.
Make money, right? Buy low, sell high.
Mm-hmm. Exactly.
But when you look at the blue line, which is as of I believe earlier this week, it's the opposite. It's inverted, and that's the term that we use, or people out there use, which is called that it's an inverted yield curve. Why? Because if I look at my shorter maturities, my 1 month, 2 month, 3 month, 6 months, I am getting paid more than if I am going to a 3-year, 5-year, 7-year, 10-year. So that is not a normal yield curve in a sense.
Right.
And that indicates, it could indicate many different things, right? But it could indicate concerns about, the economy. It could indicate that perhaps there's a recession coming. It could indicate that people don't want to lock their money longer for X number of reasons, right? So those inverted yield curves typically have, preceded recessions. Not every time, but they typically have preceded recessions. So that's why, again, and this inverted yield curve is unique because it's been a while, and we'll go into that. And it's also pretty inverted.
Right.
We'll go into that.
I heard a really interesting someone described the yield curve. When it is inverted, being inverted itself is not a sign that a recession is necessarily coming. It just shows, like you were saying, Monica, it points to investors' appetite for treasuries. For some reason, people are less willing to take on risk for holding treasuries for a longer period of time. So that could be any number of reasons, but typically it means there's something fragile going on within the economy, and all it takes is one potential catalyst to then tip the economy into a recession from that point.
Right.
So I think that could be where we've been for the last, I don't know, how long has the yield curve been inverted now? Since the spring of last year?
It's actually since October of 2022. And you can look at different segments of the curve. You can look at the 3s and the 10s and the 2s and the 10s.
Right.
So you can look at different segments of the yield curve. But when you think about the 3-month and the 10-year, that has been inverted since October of 2022, which by historical standards, it is a pretty long time frame of inversion. Yeah. And I did this earlier this week, but when you look at the 3-month Treasury, that's paying about 5.45% earlier this week, right? And the 10-year is about 4.34. So that is about 111 basis points. And, the numbers as of today might be slightly different. I just did this graphic earlier this week, but that's a lot. That's a pretty big inversion. And it's also been going, I think, for 213 trading days. So that's also a long period of time. And when you look at this 3-month to 10-year inversion, it's only happened in 4 previous occasions in the last 40 years, right? And every time that happened, the economy did stall, and the Fed was then, kind of prompted, right, or forced to lower rates to stimulate the economy, which we'll talk about duration, which is what we were also going to talk about. But that has also meant that as rates get cut to stimulate the economy, that has helped bond prices at that point. Now, we don't know what's going to happen this time, and we know that we're going on it's long on the tooth. Right. But what we do know is that whether we have 1 more rate hike or 2 more rate hikes or even 3, we are getting closer to the end of the hiking cycle versus the beginning of the hiking cycle. And historically, those are good times to start considering extending duration, which is really, okay, instead of buying a 3 and a 6 month, maybe I'm going to start buying a a 3 and a 5 year
Right.
or a little bit longer.
Right. And we
Now-
can jump to the inversion. I just want to, because you said that, right? We're probably closer to the high than the low at this point, right? And we have the yield curve up on the screen. So just to be clear, when we look at the yield curve, theoretically, a 2-month, or let's call it the 3-month U.S. Treasury, the way that yield is priced should theoretically equal 3 1-month U.S. Treasuries. You buy a 1 month, you hold it, it matures. You buy another one, you hold it, it matures. You buy another, you hold it. Over the course of that timeline, the market is saying that's why they're pricing the 3-month yield at where the 3-month yield is. Or if we look at the 6-month versus the 1 year, right? The 1 year should technically equal to 6-month U.S. Treasuries. You buy a 6-month, you let it mature. You buy a new one. You let it mature, that gets you to a year. So when I look at the yield curve, that's telling me that the market thinks we're probably going to peak somewhere between 4 to 6 months in terms of yields, and that's why it then dips, because the market is saying, well, after a year, after 2 years, you should expect lower yields from the Fed, from the Fed moving rates down.
Yeah, Austin, and I think that you got a little technical there. I might need a margarita now.
So I was afraid that Nick can bleep me out, I guess, if it was too much.
No. But it's true. And the thing is, when you look, again, in the past, and we say the past doesn't repeat itself, but often rhymes, the typical sweet spot in which you can extend duration after the inversion occurs is 6 to 18 months. So we are kind of right there, because it inverted since October 2022. So just food for thought as to where, are we there, and are we closer to that, as Austin says? So maybe, yeah.
The market. I'm not making any claims here. Don't put that on me, Monica.
I mean,
but I understand what you're saying. I understand what you're saying.
We're making a really good case for clients to start extending duration. I get that. I mean, we can talk about what we're doing for our client portfolios in a moment, but let's flip this on its head. Why do we think that this inversion is historically much longer than past inversions? And it's
should
also.
I flip to the next slide?
Yeah, sure. I mean, why do we think not only is the inversion lasting longer, but it's more inverted, historically speaking, than it really has been, I guess, since the 80s, which was also a similar period of very high inflation. Can you guys think of any reasons? Or
Yeah, and do you want to take a moment to just explain what we see up here?
Sure. Yeah, this is just the yield curve over time. So as Monica mentioned, we're taking the difference in spreads and interest rates between a 3-month Treasury bill and the 10-year Treasury note. Okay, so the difference in those yields gives us what we call the spread, I guess, and we're measuring that over time.
So below the dotted line means that the 3-month is currently yielding more than the 10-year, and then above that line means the 10-year is yielding more than the 3-month.
That's correct. The gray shading in the background is the federal funds rate tied to the scale on the left there. But anything under that dotted line is signaling an inversion of the yield curve, where the short-term rates are higher than the long-term rates, which is a signal of potentially economic weakness. So you can see on this chart here, and for those listening, take my word for it, I guess, and go check us out on YouTube. But the inversion is much deeper
and longer,
and it's been inverted for much longer. Exactly. So back to my question, can you think of any reasons why that might be the case this time around?
Well, it could be a function of where the interest rates have been over. I mean, it's been a prolonged period of time where rates were artificially kept low.
Yeah.
So that might be, as the Fed really started to try to normalize rates, this happened. But, that's what I could think of. I can't think of other things. What about you guys?
That lag effect is taking longer, possibly. Right. So they're forced to raise rates more than they would have maybe 10 or 15 years ago. Maybe we got so much stimulus from the pandemic. Right, I hate to say this time it's different. Those are the famous last words anyone should never say. But maybe if there is a time for it to be different, this is it. And maybe it's the consumers are so resilient. Growth has been so resilient, like you talked about, Monica, that the Fed has had to push a lot further than probably they thought, and clearly the market thought as well.
Right.
Yep. Agree.
So I think we've got a couple quick slides we can look at just how this inversion stacks up against historical inversions as well.
Sure.
Is that right?
Sure. And I think we can, we alluded to this, so we just, like this chart here, it just shows that where we started the inversion, which was the exact date is November 8th, and where we are and how many trading days have taken place over that period. And it also shows the magnitude of that inversion, right? So where it peaked and where we are currently. I think I had 111, but we're pretty close to that. So that's this chart.
And I will just note, I was looking at this earlier this morning. I think we're around 70 or 80 basis points of inversion today. So that's continuing to move in the right direction. The one thing I would cause, maybe a cause for concern in that is that the yield curve does tend to uninvert before recessions happen.
Yeah, and I think I'm going to go back to this duration conversation, right? Because even people say, okay, well, I'm getting 5.5 with a 3-month or 6-month. Why would I go a little bit longer if I can maximize my income here?
Right.
But as I think Adam or Austin, you said, they don't stay inverted forever. The sweet spot is at some point before, before the rate hike cycle finishes, and then you have to look at what's going to happen, like say 12 months after, right? And when you look at that, and if the recession comes or if the Fed needs to cut rates, you're not going to be able to get those. So giving up a little yield, but going up a little longer, but to really keep those yields for 3, 4, 5 years makes a lot of sense, because then you might not, at the time where you say, okay, I'm ready, you might not be able to do that at that point.
Right.
Today, we know that 5.5 is greater than 5, right? Comparing the 6-month to the 2-year. But where will the Fed be in a year from now? Will you be able to renew that 6-month bill at 5.5%? 4 times over? Likely not, right?
Right.
And what are the reasons the Fed's going to cut rate? Either they win this battle on inflation, right? That would cause them to cut rates, or we have a recession and they're cutting because they need to start stimulating the economy and get banks lending again and get people out there spending and moving the money around. So, who knows which of those scenarios will occur? I hope it's not a recession. But historically, that's sort of the way things are pointing.
Right.
If you look at some of these data points.
Right. And if you think about so when you look at peak treasuries or even peak CD rates, right, in the past, and then you look forward and you say, okay, when in the past we got a peak treasury rate or a peak CD rate, what happened 12 months after that? And most of the time, I could tell you 99%, and we don't have a chart on this, but all the not treasuries were the ones that did better. It was really more like core fixed income or things that had a little bit more duration. Again, going into this whole duration concept where, yes, you might forego a little bit of income right now, but looking to the future, looking 12 months forward, other types of fixed income investments will outperform just the treasuries or CDs as they have a little bit longer duration.
Right. And it also gets into how emotional people are as investors, right? It's, gratification now versus delayed gratification. Gratification now is going to get you a 5.5%, 6 to 4 month U.S. Treasury. Gratification later means, looking big picture, going a little farther out on the yield curve, right? And then collecting that higher, locking in that yield curve while it's high, so that when the yield curve falls lower, you're going to reap the benefits of that.
Yeah,
So-
and I think there's another chart. Sorry, Austin.
No.
there's
Yeah. So do you want to do this one, or should I skip to the bigger
next one.
The next one. So you're gonna have to explain this, because when I saw this come through as a slide deck, first thing that popped in my head is what the finance is going on here. So can you take a minute and just explain what all these lines mean?
Well, so these are just, it's a similar chart to the other one. I was thinking about another chart, which was talking about the 5-year versus the 3-month
Hold on.
Treasury.
I can jump to that.
This one.
We're
because the
gonna
other
have
one
to
we
solve
talked-
that issue, though. We're gonna have to rewind and solve that.
I'll
issue.
explain.
cover it.
I'll
Okay,
explain
okay.
that. But what I was going to say here is that, kind of like when we talk about duration, extending duration, it doesn't really mean go and buy a 10 and 20 year treasury or anything like that. It just means like, taking baby steps in a sense. But what these charts are saying is when you look at the 12-month after, and you look at the 6-month, and you look at the 5-year, and you look at the 10-year, and you look at where they were 12 months after the yield curve inversion, the 5-year treasury is historically being 25% higher than the 6-month treasury. So again, this whole instant gratification and saying I'm foregoing a little bit, it does show that 5-year you will be getting a higher return over the next 12 to 18 months.
Right. So the chart on the left. Do you want to explain it, Adam?
Well, I'll let you explain the chart, but in other words, the combination of a lack of price declines and a higher yield for longer gives you a higher total return. It's a better investment over the life of holding that treasury. Is that what you're getting at?
Me or Austin?
Right.
Yes, Monica. Yeah.
Yes, correct.
Yes.
Okay.
Yeah. So and the chart on the left tells that story, right? If all the way on the left we have the 10-year U.S. Treasury, the yield, the 5-year U.S. Treasury in, was it red or orange? The lighter blue, the dimmer blue there, the 6-month U.S. Treasury. The yields are all roughly the same at the left end of the chart. That is what? That is right when the yield curve. That's
Before the inversion.
Before the inversion. And then that's what, 6-month, 12-month, 18-month after the inversion?
Yeah.
Correct.
So what we're seeing here is the dark blue line, the 10-year U.S. Treasury, versus, let's say, the lighter blue line, the dimmer blue line, the 6-month U.S. Treasury. As we get 12 months after the inversion, on average, the 10-year U.S. Treasury is yielding more than the 12-month. Am I reading that right?
Yes.
Is yielding more than the 6 month. Sorry. So the 10 years yielding more than the 6 month, 12 months after the inversion.
The shorter your bond, the quicker it drops after the
Right.
inversion. The yield drops, right? The nominal yield. Yeah.
Right, which is what we're talking about, of locking in the yield curve while it's high, right? And then even 24 months out, right, we got the 6-month yielding less than 2%, while the 10 years still yielding around 4%.
Exactly right.
On the right side of the chart, on the right side of the slide here, this chart, average forward cumulative return after the yield curve inverts. This is showing cumulative performance after the yield curve inversion. So you could see that the farther out in time we go, that performance dispersion becomes more clear between the 6-month, the 5-year, and the 10-year, where the 5-year and the 10-year bond, that cumulative return is a lot more. There's an excess return above the 6-month, right, as we go farther out in time because of locking in the yield curve.
Right. So this
Yeah.
is a little bit mind-melting to comprehend all of this, but
On a
the
Friday
point
afternoon.
on a Friday afternoon.
Essentially, it's
as
saying
we're
we're
recording.
right. It's saying we're right.
But yes, take our word for it. You do want to lock in higher rates, albeit they might not be the highest on the curve, but you want to lock those in and start locking them in for longer as the inversion gets longer in the tooth, right? Because as we're seeing now, we are less inverted in the yield curve than we were, 6 months ago.
Even earlier this week.
Mm-hmm.
Even earlier this week, exactly.
Now,
So
I think your mindset and your investment horizon really plays a factor in here too, though, right? If we're talking about cash you have sitting on the sideline that you need to keep as cash, right?
right, don't lock that up. For
Don't
10
lock
years.
that up for 10 years, right? That money, I would say if you have an expense 2 months out, why not put it in a 1 month or a 2 month treasury, earn 5.5% yield? It's tax free from a state level. So, those New Jersey, people, that translates to above a 6% tax equivalent yield, right? Why not use that? Why not stay in that lower end of the yield curve, take advantage of the environment? But for those people who have cash or short-term bonds, but have an intermediate term to long-term investment horizon, now's the time to be thinking ahead, right? It's not about immediate gratification. It's about, that long-term, that delaying that gratification and really coming out on top over the long term and making those smart investment moves now. And it does seem counterintuitive, but history shows us that, it works and it makes sense.
Here's a real life example. My car lease is up from its lease in the end of April. So I am taking money over time and putting it into a treasury that's going to mature in mid-April before I have to pay the car dealership to buy out my car. I'm not going to let it run off lease because of the way used car prices have been, etc. I have some equity in the car. Anyways, I'm buying it out of the lease, but I want to maximize that cash savings. I'm not going to leave it up to the stock market over the next 6 months. I don't know. The market could be up another 5-10% for the remainder of this year. It might be down, right? So what do I want to do? I'm locking in what I can in a treasury because I know I'm going to need that cash. I'm not going to go out and buy a 10-year and lock in more duration. No way. No way. So think about what the goal is for that money and, plan according to that.
Right. And even beyond that, Monica, this is a question I'll pose to you. If we're looking at a long-term time horizon, right, and I don't have much in terms of equity allocation already, when we look at the 5-year versus investing in the stock market, right, the 5-year or the 1 year, right, whatever duration you want to pick, is yielding a very attractive level relative to recent history. But how does that compare to the future potential returns of the stock market? Because I think that's important.
Yeah, no, absolutely. And I think that, as you say, Austin, what's more important really to understand your goals, your investment horizon, your risk tolerance, and that's super important, because you also, I know that rates sound really high right now and attractive, and people might say, well, I don't want to be in the stock market. But, again, if you need growth and you have a longer time horizon, even with bad times, and we had bad times last year in the market, and thankfully markets recovered a little bit. There's still issues out there that we need to deal with, but over the long run, equities are really an asset class that will give you that growth, right? Because fixed income, there was a period of time that they didn't even give you income, they didn't give you anything, and now at the very minimum they're more attractive. But again, if you need growth and you have a long enough time horizon, it's also that delayed gratification, right? Because on average and over a cycle, you're going to get higher returns with equities, even with the bad times baked in. And fortunately, the bad times the good times in the market more than outweigh the bad times. So it's, again, very important. Work with your advisor, work with us to make sure that you have a financial plan, you have a clear understanding of where you are in terms of risk tolerance, because going through a year like 2022, it's not easy, right? If you have more equity or more risk than you should have taken. So make sure that your portfolio is consistent with your tolerance to risk and also with your goals. But equities do have a very important piece in any investment portfolio over time.
And this year's a good example of that, right? I can't tell you how many CNBC interviews I listened to in the beginning of this year where there were portfolio managers saying, why not? Why wouldn't I lock in this? I think it was 4% at that time, 4% yield. Right, the stock market's looking risky. The best thing I can do for my investors is lock in that 4% yield. Well, guess what? If you did that, we're 9 months into this year, you would have missed out on 15% upside in the market relative to locking in 4%. There's a big difference there.
Yeah.
Absolutely.
No, it's just important to make sure that you don't have more. When it's good times in the market, everyone wants to have more equity, and it's just important to really make sure that the bad times and the volatility that comes with being in markets is factored into your investment plan. And that's why we work with our clients, diligently and always to make sure that we are pulling in all these factors in creating an investment strategy that considers all of these factors.
Right.
Well, I think that might be a good place to. Should we start recording now and dive into the presentation?
I'm still wondering about that slide, which I guess we could save the viewers on that. We could save the viewers on that.
It's done.
It's over with.
We're past it.
Past that. Okay.
Well, this has been a blast. Thank you for joining us, Monica. One thing we're going to do across all of these podcast endeavors that we do is try and find something non-financially related that our viewers and listeners can take away. So tell us, you mentioned margaritas. I know you're a big fan. What is your go-to tequila of choice at the moment?
Ooh, good question.
Okay. Well, that's a good question for a Friday afternoon. I will tell you.
In full disclosure, I did ask you guys. It's a Friday afternoon when we're recording. Should we come with a margarita recipe and sip something here while we're filming? But
I would have done it. I just didn't have time. But I will tell you. So I mean, I love a good margarita, but I also like to sip tequila. Like I like to enjoy the flavor of it, and for a margarita, and I'll give you very quickly. A very good recipe for a margarita that you can do at home and pick your favorite tequila. For a margarita, you just need a good silver tequila. You don't need an añejo, or you don't need a reposado or anything like that. Good silver. You can go with your silver of choice for that. I like Fortaleza. Fortaleza has all, great. But it'll become a more expensive margarita a little bit. But, you can get really good tequilas. But I also like for sipping, I like Compoveda, which, as a team, we did a tasting, and I think the whole team loved it. So it's a good one, and it's excellent for sipping or for a gift. It's excellent for a gift. And I don't work for the company. Right. So, but I'll give you real quick the margarita recipe. Just get your favorite white silver tequila, and you're going to mix. A Blanco.
You got to roll your tea.
Yes.
Blanco. So you're going to just mix 2 parts tequila, 1 part. You could do triple sec, or you can do control. If you want to make it a little more expensive too. But you need to get, and you can get this on Amazon, you could get spicy honey. You can get it on Amazon.
Ooh.
You can get
spicy honey sounds good. Yeah.
Oh, it's great. And this is all to taste. Tajin, I don't know if you guys know what it is. Is that little powder that's red?
Mm-hmm. Yep, the spice. Yep.
So that's how you're going to for the rim, and you're going to squeeze, lime is to taste, and then that's basically it. You could do a little splash, like just a splash of orange juice for color. Okay. But taste it. You can go a little heavy on the tequila if you don't want to do 2 parts, 1 part. But I'm telling you, you will impress your guests. Make sure you get the really nice margarita glasses, rim the glass, and there's no margarita mix involved. There's no simple syrup. It's just the spicy honey, and you're going to impress anyone. Yeah, so go plan a party and have a margarita.
Cut a lot of the bad sugars out, yeah.
Right, yeah. Just make sure if you're doing any client reviews the day after we release this filming that you ensure that they haven't had too many margaritas.
well, they might love the margarita. They might be happier to have the review after.
That's true. So. Yeah. There you go. Excellent.
Yeah.
Excellent.
So, if you have the ability to comment and you try this recipe, you have to comment and let us know if you liked it.
Please do.
To our viewers.
Yes.
Yeah.
Austin, what's new with you?
So I put down 2 things. So I don't know if you watched football last night, Thursday Night Football on Amazon Prime. They have the new Prime Vision. Have you tried that? So
no, I heard about it though.
Yeah, so they're using AI. So they're using AI to help predict, which players you should focus on, right? So if they think a player is going to blitz, they'll highlight that player. Or they think a player is going to be open and a good candidate to get a pass, they're going to highlight them. But I was watching it and it was just horrible. It was horrible because they put a little circle around all the wide receivers, and my eyes are following all like the little circles, and I'm not even looking where the ball's getting thrown. I think I think conceptually it's a great idea. It's a great idea, but it's just right now I don't think it works, or at least not for me. I'm looking one way, the ball's going the other way, and I'm missing out. I actually turned it back to the traditional football view. Yeah.
So you're saying we're not all going to lose our jobs to AI?
No, we got some kinks to work out.
We're safe. We're safe.
Yeah.
Excellent.
The other thing that's new is so Meg is always getting medical advice online. I don't know if you guys get your medical advice online too, but I'm always making fun of her. I'm always posing did you think about this or this, or I didn't realize the internet. I didn't realize your PhD, right? You had your PhD in health or medicine or something like that. And so over the summer, I was getting this pain in my arch, in my left foot. I couldn't figure it out. I figured, my calf is tight, right? I play in these old men volleyball leagues. I figured it was probably from that. I just didn't stretch right, ice it down, whatever. And it just persisted. I'm scrolling through Instagram Reels, and it's this woman. She pops up. She goes, "When you get out of bed in the morning, does your arch feel like it's all crimped up?" And I was like, "Wait a second. That's me." And she keeps explaining. I'm like, yep, sounds right. And so she says what it is and starts explaining how to fix it. So I was like, wait a second. So I went on YouTube, I Googled it, and I found some physical therapists or a YouTube video, and he gave you some stretches to do, and it worked. I have zero arch pain now. I've been doing the stretches for about a week, and so now I guess I have to apologize to Meg, because I guess sometimes medical advice online works.
So are you doing flowers or wine or dinner? What's the plan?
Yeah, well, that's true.
That's good.
She'll have to make it through all of the finance jargon before we get to my apology. So
there you go. Well, I watched. I binged I was flying back from LA. We were there for a conference, and I haven't binged a show in a long time. With kids, you rarely get more than an hour or two after they go to sleep for free time. But first time binging a show on this flight, it was fantastic. Silo, which is on Apple TV. It's a sort of sci-fi thriller. Takes place in some alternate reality future. But okay. I would highly recommend it. It's about an underground silo that has been dug out and turned into, 200 stories of apartments, and it's a self-sustaining world, basically underground. And there's, different government factions and different political beliefs, and it's its own society built in this, trapped in this silo. And from time to time, people under their own will can leave the silo if they so choose. But it's all about, finding out how they got there, why they're in there in the first place, and what is their future hold. So I would highly recommend it. It's on Apple TV.
I think there's something to be said about TV shows that offer an alternative reality, whether it's more of a sci-fi or just bringing you back to, the Midwest during the gold rush, right? Because it's like you deal with the stresses in your day, and you're constantly thinking about work, or you're thinking about family stresses, and just to be able to binge something and that brings you into a world that's just nothing like your own, where you just you can escape there almost. I think there's definitely something into that. I know me and Meg, we can't wait for... what's that Western with who's in that? I'm not thinking. I am giving you no good clues. But anyway, it's delayed because of the writer's strike. But I think there's.
I was going to say Yellowstone.
Yellowstone.
That
Yellowstone.
Isn't that over? Or didn't
No. There's more seasons to come out. It's being held back by the writer's strike.
Got it. Okay.
And then should I download Apple TV? I am so afraid to download more streaming devices. I feel like I have 3 or I maybe have 4 or 5, and I'm like,
there's a lot
really
of good content on there.
Yeah.
I don't know. I have the little Apple TV device. So what's
you can buy that device. I mean, it's just like you just plug it. It's easy.
Right.
So, but
do you have Apple
there's some
TV?
good stuff. I do.
Yeah. Okay.
Yeah.
I feel like I was one of the first to cut the cord, probably 4 or 5 years ago, and maybe longer at this point. And now it's just the same price as what cable used
It's
to
so
be.
expensive.
Right.
It's
It's
just
so
what's
expensive.
the point?
People are asking for
that-
bundles again.
Yeah.
right. They're just gonna. Oh boy, here we are back at the beginning.
Right.
Well, this has been great. I think
been a
we'll
lot of
leave it
fun.
here. It's been a lot of fun. Thank you for joining us, Monica. And we hope that all of our viewers and listeners go ahead and drop us a thumbs up, a like, a heart, whatever it might be. Shoot us an email if you'd like with some commentary on what we should incorporate into the future. So thank you all again, and hope you have a wonderful weekend, evening, morning, wherever you find yourself listening or viewing us.
Great.
Thank
Thanks.
you. Thank you for having me, guys.